Welcome to the Universal Accounting Center's Advancing Your Accountability with your accounting instructor, Alan Bostrom. In Session 4, Cash to Accrual Conversions, you'll learn the pros and the cons of cash accounting, and you'll learn how to set up a cash accounting bookkeeping system, then convert it to accrual accounting. Through this technique, you will enjoy the benefits of both methods while shortcutting the bookkeeping process and meeting the needs of the tax preparer and management. And now, here's Alan.
Today we're going to deal with cash and accrual methods of accounting. Now, to this point, all the work that we've been doing on practice sets, we have been using the accrual method. Now, the accrual method is actually the more difficult of the two. And so we're actually then going to show you how to simplify it, how to make it simpler, but yet we still want to have some of the characteristics of the accrual method. Now, to illustrate that, I'm going to put on the board the two methods and show you how transactions would be handled, first of all, in the accrual method, because that's the one you're familiar with, and then we're going to look at how the cash method would handle that particular transaction. So let's consider the fact that in December, we're going to make an entry. Under the accrual method, if that entry were for a purchase of, well, let's do it this way. Let's talk about sales for a minute. Let's imagine that you are doing bookkeeping for clients. And in December, you perform all the bookkeeping for the month of November, and you present the financial statements to your client in December with a bill for, say, $500, okay? Now, this client's one you've been with for a while. He has adequate cash, and so you allow that client 30 days to pay his bill. So he's probably not going to pay it till sometime in January. Do we make an entry in December? Yes. Yeah, we do. And that entry should be fairly mechanical at this point, okay? It's $500. The customer's going to pay us in January. What entry would we make in December? What are we going to debit? What are we going to credit? Okay, we're going to accounts receivable. Are we going to debit or credit accounts receivable? We're going to debit accounts receivable for $500, right? Okay, what are we going to credit? We're going to credit sales $500, okay? Now, in January, we get a check, okay, for $500 from our customer or client. So what's the entry going to look like in January? Jen, what are we going to debit? We're going to debit the bank for $500, okay? And what are we going to credit? We're going to credit accounts receivable, okay? So what's the balance now in accounts receivable as it applies to this particular cell? Zero, okay? That is offset by that, right? And the result is that we increased the bank $500. We recorded a sale for $500, correct? Took two transactions to do it, but we got it all done, okay? Now, the cash method of accounting differs from accrual because we don't record the transaction until cash actually changes hands. So since in December, no cash changed hands, no entry in December. However, in January, when we do get the cash, we're going to increase the bank $500 and credit sales $500. Okay? We eliminated accounts receivable, and so in the cash method, you don't have accounts receivable. You don't need accounts receivable. Is that easier? Sure. Instead of two entries, we did it in one. Now, if you'll look at this, in both cases, we debited the bank, didn't we? In both cases, we credited sales. So what's the difference?
You don't have any transactions in December itself.
That's right.
All in the
It's all in January, isn't it? And so the only difference is when we recorded the sale. Okay? Under the accrual method, we recorded the sale when it happened. Under the cash method, we record the sale when we get the cash. Now, turning it from two entries to one, certainly simplifies it, doesn't it? But there's a downside to that too. I don't know if you see that. You see that downside?
Maybe that how you tracking yourself.
Yeah. Yeah, how you're tracking your sales. Let me give you an example. Now, a lot of you are going to, or thinking of freelancing, okay? And you might be offering tax services, either at the beginning or later on. Well, what happens in tax services? You make all your money in just about 2 months, don't you? Okay? March and April is when the most of your money comes in. And for some people, that's all they make during the year. They might take vacation from April 15th till February 15th the next year. Not really. I mean, they're not going to live abundantly on the 2 months, but they can make a lot of money during those 2 months. Okay? So let's imagine, most tax preparers don't do this, but let's imagine that you've got a lot of clients, and all of your clients you make a special offer to. That if you do their taxes, they don't have to pay you until May. You know, sort of like some of these special sales that they have for furniture and cars and electronics and things like that. So you do their taxes for them, March and April, and you work around the clock practically. I mean, you are working yourself to death during those 2 months. And do a lot of tax returns and have a lot of billings out there. Do you follow that? No cash coming in, but a lot of billings going out. Now, April 15th, you take off for a well-needed 2-month vacation. Okay? While you're gone, someone's taking your money in and when all the checks start coming in May and making deposits. Now, if you were in the cash method of accounting, when would you be recording the sales? When the cash shows up, which is in May, right? When did you do the work? March and April. Now, if I were a small business consultant and I were looking at your sales for your business, I would look at March and April and I would say, man, whatever you did in March and April, never do that again. Because there were no sales. But look at May. Where in the world were you in May? And go back. Okay? Do you follow the problem here? It doesn't give you any timing or tracking of sales. Okay? So that's a problem, isn't it? Okay? And so we want to address the fact that even though cash is easier, the accrual has the accuracy portion. And we'd like both, wouldn't we? Wouldn't you love to have it simpler but accurate? Okay? So what we want to do is, we're going to go through the expense side in a second, but what we're going to show you is how to take the advantage of the cash, the simplicity, but then in a very simple conversion entry at the end of the month, convert it to accrual. Do you follow that? Therefore, getting the advantage of the simplicity during the month, but getting the advantage of the accurate at the end of the month, or when you prepare the reports. Okay, let's look at the other side, because we want to understand the cash method of accounting and accrual as it applies to expenses as well. To do that, let's imagine that you get your cell phone bill, okay, in December for $100. And you don't have to pay it until January, so certainly we're not going to write a check until January for it. So, but have we incurred the cost in December? Sure, we have. So what entry are we going to make in December to record this bill? We're going to, debit or credit accounts payable? We're going to credit accounts payable for $100. What are we going to debit? What are we going to debit? Telephone expense, okay? Telephone expense, okay? Okay. So that's a debit for $100. Now, in January, when we prepare the check, what's the entry going to look like? We're going to debit or credit the bank? We're going to credit the bank $100. And what are we going to debit? We're going to debit telephone expense? No, we're going to debit accounts payable, aren't we? Okay? Now, that $100 credit then is offset by that $100 debit, correct? So the balance in accounts payable is 0. The end result is that we've credited the bank $100 with the check, and we've debited telephone expense, correct? Okay. Once again, what's the difference between the accrual and cash methods? We don't record a transaction in the cash method until cash changes hands. Did cash change hands in December? So no entry in December. But in January, when we do write the check, we're going to credit the bank $100, and we're going to debit telephone expense $100. Same thing here, see? In both cases debits, both cases credits. So no difference there. The difference again then is the timing of when we recognize the expense. Okay? Now there's a concept in accounting we call matching. And matching is matching the expenses to the revenues. In other words, what we want to do is we want to look at what were our sales and what were our costs to get those sales. Now, if all of our sales were in January and they were all cash sales, we're going to record them under the cash method in January, aren't we? But if all of our vendors allow us 30 days to pay the bills, when are we going to record the expenses for those bills? For those sales, excuse me. In January, when we write the check using the cash method. Again, a timing problem, okay? Again, if we can have both, that's better. So we're going to try to do that. Certainly it's obvious that the cash method is simpler, right? Now there's one other advantage to the cash method that I will mention, and we don't want to lose its advantage either. So whatever system we talk about in here, in this conversion, we need to have the advantage, all the advantages in our favor, okay? Isn't this great? When you can have a pie and eat it too, okay? We're going to show you how to do that. But under this method, the advantage is that for tax purposes, and tax purposes, you could be either a cash taxpayer or an accrual taxpayer. You have that choice. You make that decision initially when you prepare your first tax return for businesses. Okay? Individually, you're all cash. But businesses, you could be either cash or accrual. Now, most businesses will start out cash and they'll stay that way when they're small and then eventually go accrual. And the reason why they start out in cash is because cash is easier. We've already talked about that. But the cash method also permits you to manipulate your taxable income. Is that good? Doesn't sound good. It sounds almost sinister, doesn't it? Okay? But the IRS allows us to do that because of the timing. It doesn't say you cannot report sales, but it allows you to actually time when you report the sales. Now, here's an example. Let's say that in December, our tax year ends in December, and we look at all of our sales, and we're going to have a very good year. I mean, this year the profits are going to be very good, and we're worried about having to pay a lot of money in taxes. So we look at our accounts receivable, and a lot of our sales haven't been paid for yet. They're sitting up there in our sales number, but they haven't been paid yet, okay? So we think, I don't want to report all those sales. It will help my taxable situation. So I'm going to write a letter to all of my customers. And that letter is going to say, we really appreciate you as a customer, and we know how busy Christmas time is and how expensive it is. So, to show you how grateful we are to you as a customer, would you please not pay your bill until January?
Yeah, right.
Okay? You think that happens out there? It does. It does happen. In fact, sometimes they even advertise those types of deals on television. Okay? And so what they're trying to do is what? By not getting the cash until January, they're not going to have to record the sales until January. Which is a great benefit because this year then that's going to hold their income down, isn't it? Okay? Do you see how they were able to manipulate? Even that, though the sale was made in the current year, they're not going to have to report it until next year. Now, they are going to have to report it, okay? I mean, it's just going to be a timing difference. Or what about the other side? Can they manipulate the expense side of their income? What could they do? How about pay a lot of their bills in December? Pay their January rent in December. When, if they're using the cash system, then when do they get the expense? They're reducing their sales, right, by saying don't pay me until January, and they're increasing their expenses, which means what's happening to their net profit? It's going down, okay, significantly. And it was just based on timing. They're going to pay their expenses, but they're going to pay it a little bit early because they want the expense this year. Now, this is a vicious cycle, isn't it? Because what's going to happen next year? They're going to have to do the same thing. Unless next year just isn't as good a year generally, and they do need more sales and less expenses, okay? But businesses often can get caught in a cycle here and eventually have to pay the piper and just bite the bullet, okay? So, recognize that the cash method permits us, one, it's simpler, and secondly, it permits us to manipulate our taxable income. But what's the downside of the tax or the cash system? It's not tracking your receivables or payables, and what else? It's not as accurate. Not as accurate, okay? Now, with that in mind, which one do you use at home? Are you on the cash or accrual? You're on the cash at home. Why are you on the cash at home? And because it's a whole lot simpler. Okay? I mean, whether you're cash or accrual, you're not going to pay your bills till you have the money. Okay? It's just on an accrual system. You're showing that in the books, and you're showing that those are bills that might be getting older and older and older. Under the cash system, you're not showing them anywhere, except for they're hiding in a cubby hole somewhere around the house until you get some money to pay those bills, right? Okay? We're on the cash. I mean, when a lot of you, your pay period might end on December 31st, right? But you don't get paid until the 5th or 15th of January, something like that. When do you record that you earned that money? January, when you get it, right? You don't show that the boss or the company owes you that money. So that's the cash system. Most of us, when we buy something on credit card, when do most people record that purchase on the credit card? When you pay the credit card bill, right? And not before. Now, a lot of people do choose to report the credit card on a regular basis. And if you've got a software program like Quicken or something like that, very often you'll record that as you're buying those items. And that's more the accrual system, okay?